As we transition from a portfolio focused on price appreciation to a portfolio that pays us simply for holding it, preferred shares are a great way to help generate high yields. To learn more about preferred equities as an option to increase your cash flow, including the funds that I'm investing in, hit that subscribe button and join me today, right here in the red zone. A preferred share generally gives up the voting rights present in a common share in exchange for a higher dividend payment and a higher claim to assets if the company folds and liquidates. In a very general sense, they can be thought of as a hybrid asset between common stocks and bonds, although their overall characteristics are closer to fixed income. Before we dive into some of the positives and downsides to preferred shares, for those who are new to the channel, in 2024 I entered the red zone, those 5 to 10 years prior to and after retirement, and that's when I began to transition my portfolio from an accumulation style to one that takes some downside risk off the table and more importantly, helps replace my paycheck through dividend payments. Some attributes of preferred shares include first, as I already mentioned, they provide a decreased risk compared to common stocks if a company goes under. Even if we're just talking about a dividend cut, except in very specific types of preferred shares, preferred holders get paid first. Second, their price generally won't fluctuate as much as their common stocks equivalents, which could allow your portfolio to retain value in the event of broad market declines. Their standard deviation, their beta, as well as their correlation of about zero point 0.7 to the market all indicate a good diversifier, although the price movement will likely be in the same direction the majority of the time, just less of a movement. Third, preferreds pay higher yields than common stocks, which helps provide a paycheck for us in retirement and helps to mitigate against sequence of return risk in the red zone. Fourth, individual holdings can be pretty complicated, more so than common stock. I won't go through this entire list, but as a hybrid type of investment, preferreds have a lot of characteristics that may or may not be present in an individual holding. If you're interested in deep diving any of these, I've put a link to a good overview in Investopedia so that you can learn more. For me, the complexity with these assets means that I will likely invest in an ETF rather than attempting to pick individual preferred stocks. Finally, price appreciation is limited. If you are interested in price appreciation as opposed to income, then this type of investment may not be for you. Since our goal in the red zone is to provide some portfolio stability, but also cash flow as we no longer have an employer provided paycheck, for me, the positives outweigh the negatives for a red zone investor to give this asset class a look. As I mentioned, for preferreds, I prefer to let others handle the complexity, and the good news is that there are plenty of ETFs and CEFs in this space to choose from. Here's a few of them. First up for my shares, we have PFF, which currently yields about 6.5% and is the largest preferred ETF with over 13 billion in assets under management. What I like about PFF is its overall size and close to 500 holdings, which makes it the most diversified of the group. Although 70% of those holdings are in the financial sector. Now, note that this is not unusual for this particular space, as roughly 80% of all tradable preferred shares are in the financial sector. Next up, we have ticker symbol PFXF, which currently yields above 7% trailing, but that is due to an outsized dividend payment in December of 2024 that paid more than double any distribution so far in 2025. If we look at its payouts since February of this year, PFXF is yielding only about 4%, but traditionally its December payouts are larger. However, last year's was unusually high when we look at the past 5 years. What I do like about PFXF is the fact that it avoids the financial sector altogether. So it prevents overweighting your portfolio allocation to the financials if you invest in preferreds, but it seems that doing that reduces your reward. Next up, we have an offering from Nuveen, ticker symbol JPC. JPC is a leveraged closed end fund that holds about 40% preferreds with about 50% corporate bonds, with over half of its holdings rated as investment grade. What I like most about JPC is its yield of over 9.5%. Next up, we have HPI from John Hancock, which is another leveraged closed end fund like JPC, but in HPI, preferreds make up close to 80% of its portfolio. Like JPC, it has a starting distribution of above 9%. So both of these funds seem similar between JPC and HPI, so I'm looking forward into diving into these two funds a little bit further in the future. Next up, we have an ETF from Global X in PFFD that, according to its prospectus, tracks an underlying index designed to track the broad based performance of the US preferred securities market. There is actually nothing I really like about this fund as it has steadily cut its dividends since inception. Yikes. It's an example of what tracking fixed income indexes generally will deliver, which is underperformance. Finally, we have the Virtus InfraCap US Preferred Stock ETF, ticker symbol PFFA. PFFA is an ETF that pays over 9%, which it is able to do so through the use of leverage, active management, and mostly by holding lower than investment grade type of assets. I obviously like that yield, but I also like the fact that although this fund cut its dividend by about 20% in March of 2020, since that time it has been steadily increasing its dividend, recovering about half of the original cut. Here's a quick list of the funds I just went through, as well as some of their general characteristics. As we wrap up today's episode, feel free to leave a comment below and let the community know which preferred stocks you own or which ETF you're considering investing in. Stay tuned for my follow on episode where I reveal the preferred funds that I personally invest in. If you want to explore other sectors or investment vehicles that will also produce the income you need in the red zone, check out my episode on the utility sector and the closed end funds that are not only producing income, but generating total returns competitive with investors who are still accumulating. Until then, I'll see you next time, right here in the red zone.